The European commercial real estate market is quietly heading toward one of the most consequential debt reckoning moments in a generation, and most people outside of finance have absolutely no idea it's happening. We're talking about hundreds of billions of euros in loans that are maturing right now in 2026. And the math simply does not add up the way it used to. Here's how we got here. Back in 2019 through 2022, when borrowing was essentially free and optimism was borderline delusional, developers and investors loaded up on cheap debt to buy office towers, shopping centers, and logistics parks across Europe. Then the European Central Bank did what central banks do when inflation runs hot. They hiked rates aggressively, and suddenly those same assets were worth less while the cost to hold them exploded. The ECB did start cutting rates in late 2024. And yes, the headlines celebrated like it was the end of a drought. But here's the uncomfortable truth. Borrowing costs are still dramatically higher than they were when those original loans were written. So refinancing a 2019 loan in 2026 feels like trying to fit into jeans from college after a few too many years of holiday dinners. Think of it like this. You took out a loan when the bank trusted you with 90 cents on every dollar of property value, and now that same bank will only lend you 60 cents because the rules changed and the value dropped. That gap, that painful middle ground between what you owe and what you can borrow, is what the industry is calling the refinancing wall. And it is very real and very expensive. The office sector is getting hit the hardest, especially in major German cities like Frankfurt and Munich, where vacancy rates have been climbing as companies shrink their footprints in a post-pandemic hybrid work world. Prime locations in city centers are still getting bank attention. But secondary offices, the kind that used to be totally fine, are now essentially radioactive on a lender's spreadsheet. What's fascinating, and a little ironic, is that the same institutional confidence that fueled the buying frenzy is now the psychological anchor dragging people under. Nobody wants to admit the asset is worth less. Nobody wants to sell at a loss. And so the market gets stuck in this slow motion standoff between reality and ego. Experts call this extend and pretend. And while it sounds like a yoga move, it is actually one of the most expensive coping mechanisms in finance. Here's the historical pattern worth knowing. Real estate credit crunches have happened before in the early 1990s. In 2008, in the post-sovereign debt crisis years in Europe. And every single time, people said this one is different. And every single time, it rhymed almost perfectly with what came before. The lesson history keeps trying to teach us is that liquidity eventually returns, but not before it humbles everyone who thought they were the exception. Now, smart money isn't just sitting on the sidelines crying, it's actually restructuring the entire financing playbook in real time. Debt funds, mezzanine financing, and preferred equity are filling the void that traditional banks left behind. And while these alternatives cost more, they're keeping deals alive that would otherwise collapse entirely. Investors are also getting creative with deal structures in ways that would have seemed overly complicated 5 years ago, but now just look like survival. Joint ventures bring in equity-rich partners to bridge valuation gaps, sale and leaseback deals, let corporations unlock cash from their own buildings without giving up operations. And distressed loan-to-own strategies are letting opportunistic buyers acquire assets at steep discounts through the debt stack rather than direct purchase. One of the biggest misconceptions floating around is that European commercial real estate is in free fall, and nothing is getting financed that's simply not accurate. What's actually happening is a brutal but necessary repricing, where the assets that deserve capital are getting it, and the ones that were always marginal are finally being forced to reckon with reality, which is healthy, even if it's painful. There's also a green dimension to this story that most people completely underestimate. ESG compliance and energy performance certificates are now actual underwriting criteria. Buildings with clear decarbonization roadmaps are getting better loan terms, while energy inefficient assets face punishing financing costs or outright rejections. Which means your old concrete office block in the suburbs just became both a real estate problem and an environmental liability at the same time. Technology is also quietly reshaping how deals even get analyzed in this environment. AI-driven tools are processing complex loan structures, cash flow scenarios, and portfolio stress tests in hours rather than weeks, which matters enormously when lenders are scrutinizing every single line item before committing capital. The irony is that the same data-driven precision that's making banks more cautious is also making clever investors more efficient at finding the distressed opportunities being created by that caution. The practical takeaway here, whether you're an investor, a developer, or just someone trying to understand where the smart money is moving, is that this is not a moment for bold, concentrated bets. It is a moment for disciplined sizing, patient positioning, and a process that doesn't depend on perfect timing. The people who will look brilliant in 5 years aren't necessarily the ones who called the bottom. They're the ones who stayed methodical, sized their exposure responsibly, and didn't let conviction override risk management. At the end of the day, markets like this one are not about being right. They're about being prepared, staying rational, and having enough dry powder to act when genuine opportunity appears rather than chasing every distressed headline like it's a clearance sale. Whether European CRE finds its footing by late 2026 or grinds through another painful cycle, the investors who survive and thrive will be the ones who respected the process more than the prediction. If any of this has you thinking about your own real estate strategy, whether that's investing, finding contractors for a project, or connecting with lenders who actually understand today's market, check out our links in the description below and let's get you started on the right path.